Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Schenone, head of iShares U.S. fixed income strategy within BlackRock's global fixed income group, to discuss factor-based fixed income investing and how bond ETFs can be used as an inflation hedge. Karen, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Happy to be here.
Let's talk about the current fixed income environment. What are the key themes that you're watching?
The biggest thing we're seeing this week is the Fed meeting from yesterday. The Fed came out and announced that they're starting to taper those bond purchases. So they're going to start reducing their bond purchases by about $5 billion in mortgage-backed securities and about $10 billion per day in the Treasury market. So everyone's looking at this and seeing that they'll probably stop those bond purchase programs by next summer. And that's when we think they'll start to hike interest rates. So the market's been digesting that news, and we've seen some people changing positions accordingly. We're also in a credit environment with very tight credit spreads. So when investors are looking at where they can get yield, investment grade has pretty low yields, very tight spreads. We're seeing more people flocking to the high yield bond markets. So looking at fallen angel companies, looking at companies in the energy sector. We've had very strong corporate earnings reported in this cycle. And so I think people are feeling more comfortable taking on yield within the credit space.
And Karen, we've heard about factor-based equity investing. What is it when it's applied to fixed income?
That's right, Jill. I think so many people are used to thinking about factors in equities. So when you think about factors in equities, that's quality, that's size, small, mid, large, as well as minimum volatility. Those are all factors that we see on the equity side. Then on the fixed income side, we want to think of what are those persistent drivers of return. Probably the biggest are interest rate risk or rate risk, as we've just talked about. And the second is credit risk. So those are going to be the big macro factors of returns. But then even within asset classes, there's style returns. We also see quality and value being a big driver of fixed income returns. So think about quality, high quality companies, those that have less default risk, and value in fixed income really means how can I get the most yield per that probability of default risk. So when we can think about combining some of those factors in fixed income, we can have better outcomes than maybe a market cap weighted benchmark. And that's been some of the research and ETF strategies that we've come out with have been trying to take advantage of some of these factor premiums in fixed income.
Tell us about the ETF that gets investors exposure to this.
Yes, we have a new ETF that just got launched a few weeks ago. The ticker is USBF. This is our US dollar factor bond ETF from iShares. So USBF is really trying to get you about the same amount of volatility as you would with an aggregate index, but it's trying to have a source of outperformance from some of these factor insights. So the portfolio is going to be holding a combination of many of the same asset classes you're going to see in an aggregate holding. So it's going to have corporate bonds, mortgage-backed securities, and some treasuries, and it's going to have a maximum allocation of high yield of about 4%. So the idea is, how can we do a non-market cap weighted version of that to try to get you similar performance that you might see from an active manager, but at a third of the cost? So with USBF, you're going to see similar duration and volatility to as you would in the aggregate index. But over time, we're hoping to add value between some of these factor tilts that we're taking on in the portfolio.
And let's talk about your outlook as we wrap up 2021, if you can imagine, and heading into 2022. What are some opportunities that you see, and how can bond ETFs be used as an inflation hedge? I'm sure investors' inflation is the top of mind for everyone.
Yeah, going into the end of the year, we're seeing most investors' strategic asset allocation is overweight equities. So what that means is you've got a lot of equity risk embedded in your portfolio. So what you want to do is think about your bonds as a diversifying risk factor. So while a lot of people are avoiding interest rate risk or they're reducing duration, duration is actually the one factor that has a negative correlation to the stock market. So if you are overweight equities, think about making your fixed income a bit more conservative. As we're in a low yield environment, fees matter. So I would say look for those investments like ETFs that are low cost and transparent. And then just coming into the end of the year, we're seeing people overweight credit, trying to go to high yield to grab some income. And I think going into 2022, some things to look out for. If we do get in a Fed tightening cycle, add some floating rate to your portfolio. Our floating rate note ETF, FLOT, is a great investment grade way to do that. We're also seeing an allocation. A lot of people are underweight emerging market bonds. Those also do really well in a tightening cycle. So I can see both of those tactical tilts, floating rate and EM, being a place to be next year as we see the Fed really taking off the accommodative stance they've had in the past.
And finally, let's wrap with growth in ETFs, specifically the fixed income ETF marketplace.
Yeah, we're seeing so many investors, institutional investors, financial advisors, really discovering the benefits of ETFs in the bond market for the first time. So this year we've had about $170 billion of inflows into fixed income ETFs across the industry, bringing the total AUMs to about $1.2 trillion. But still, only about 2% of all bonds are sitting inside that ETF wrapper. If I think about the stock market, about 10% of all stocks are in an ETF, so we still have a lot of growth to go. The most popular categories have really been in the core bond space with aggregate tracking ETFs, as people are getting their 60/40s back on track. Munis and inflation-linked bonds, as you highlighted, Jill, are very popular through that ETF wrapper. Our TIPS ETF, TIP, and our short maturity version, STIP, have been some of the largest inflowing tickers this year as people are taking advantage of those CPI print increases by allocating to TIPS.
All right, Karen, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.